I think an interesting topic, I don't want to say controversial, but certainly something that you're starting to see rumblings in the financial press. It's definitely something that's probably not being covered as much. And that's why we kind of did this. We really made this as a stark conversation that says, hey, we are in a recession and why this is a good thing. So I know the whole idea of being in a recession, how could that possibly be a good thing? But I'm going to share with you just some of the thoughts and kind of how we got here, what's actually happening kind of behind the scenes and where we go from here. So hopefully you enjoy this topic. While it's a little bit of a scary one, this was designed to really just inform you on what we're seeing. And we think this will become more and more mainstream over the coming months. So I'd like to say maybe you heard it here first. So some of our disclosures here that I'm not going to read through, but you can see them up here on the screen. So I guess real quick before we just jump in, for those of you who are joining, I did notice we have some prospective clients and some guests. So my name is John Vance. I am the founder and president of Vance Wealth. We are a registered investment advisory firm. So basically we provide full service wealth management services, and we definitely specialize in working with business owners and helping them save taxes. So the big question is, okay, are we in a recession? Right, that's where we got to start. If I'm making this statement, we are in a recession. So are we in a recession? Technically, no. So for those of you who are, did not study economics in college, to be in a recession, technically, the economy has to contract for 2 consecutive quarters, right? So quarters are 3 months. It has to contract for 2 consecutive quarters. So and they measure that by GDP, which is gross domestic product, which measures the output of the US economy. So in the first quarter, so January through March, GDP was actually negative. So we had negative GDP in the first quarter. We're estimating that we're probably going to see negative GDP in the second quarter. We don't know. That's what we're estimating. And so that technically that will put us into a recession, which we won't know until July. Now, there is a possibility that this could drag on and maybe we have slower growth in the second quarter or the third quarter, but we basically feel that even if it's not a technical recession, we're there, and there's a lot of signs that are happening in the economy that we need to be aware of because it impacts spending decisions, investing decisions. So technically, no, we're not. So I do think there's a little bit of a disconnect. I think in a lot of the mainstream media, I think they're afraid to say recession, right? Because that frightens people. If you start getting under the hood of a lot of the financial media, that, like Wall Street Journal, things like that, you're starting to see a lot more of that chatter. This was a quote that came from the Wall Street Journal just last week. This was from Biden's White House Economic Counsel, Brian Deese, I think is how you say it. Our economy is transitioning, in quotes, our economy is in a transition from what has been the strongest recovery in modern American history to what can be a period of more stable and resilient growth that works better for families. So I think that the reality is we did have a strong recovery. Unfortunately, a lot of that driven by printing of money and a lot of the stimulus that came out. And then we go into more stability. I do think what happened, and so I don't really agree with that quote. I think we had a strong recovery that was artificially inflated by the government, and that's through 2 administrations, Trump and Biden. So this is not a political statement, but we had too much stimulus that came in, and because of that, it's going to have to overcorrect to the downside. So it's not going to go into stability. It's actually going to have to overcorrect to the downside to fix some of the poor decisions that have been made over the last 2, 3, 4 years. I really liked this quote from Elon Musk. I need to move my picture of me here so I can read this. But Elon Musk basically tweeted the same day. The question he was asked is, are we in a recession? He said, yes, but this is actually a good thing. It has been raining money on fools for too long. Some bankruptcies need to happen. Also, all the COVID stay-at-home stuff has tricked people into thinking that you don't actually need to work hard. Rude awakening inbound. So it's interesting that he tweeted that on May 26th. We actually set the topic for this, well over 2 weeks ago. So we're kind of feeling the same thing. It was interesting to see his tweet, because while I like that he speaks pretty bluntly about how he feels, I think there's a lot of accuracy there. And, the reason why I think it's a good thing is I think it's going to be a natural reset to people's behavior, which I think got out of alignment of reality. And I think that's actually going to be a good thing long term, even though in the near term, it does, we do believe it's going to create some pain, but that's the reality of what recessions will do. So when we move on to the next slide here. So just real quick, I don't want to spend a lot of time on the investing side of things today, meaning like what's happened in the financial markets this year. I do want to just share this one chart, and I know it's a little bit noisy, but really easy to explain. Just as a FYI, we're doing our mid-year and economic outlook webinar is going to be in July. And during the July webinar, I will be going through kind of the outlook for the next 6 months, 1 year, 2 year, 3 year outlook for what we think is going to happen in the stock markets, the real estate markets, crypto. So we'll be doing that in our July, where I start to kind of share some of our thoughts as to where we think things are heading. Today is a little bit more of a reflection of where we came from over the last few months and also where we are today. One of the reasons why we moved up this webinar and did a special one is that today is June 2nd, I believe. I think it's June 2nd. It could be the 3rd, but I think it's the 2nd. And we know that the financial markets really accelerated their sell-off April and May. So when people look at their statements, they might get a little bit of a statement shock just because assets are down, stocks are down, bonds are down. So it's been a tough start to the year. So what we're looking at in this chart is these data points. And so if you look at the kind of the black intersection of the lines where it has the cross, in the very middle of that, basically that if you had a dot that sat right there, that means that bonds, and you can see at the bottom, it says global bond performance. That shows that would be at that dot, it would be 0% of return in a given year. And then on the left-hand side is equities. So what have global equities done? So, stocks. And so in that intersection, that would be 0%. So the majority of these data points, and this goes back to 1977, so not quite 50 years, but you can see the majority of the data points are in the top right quadrant. In the top right quadrant, you can see all those yellow dots. That basically means that in most years, you have positive returns for bonds and positive returns for stocks. We know that doesn't happen in all years, but that's definitely the majority. And then you look at the bottom right, left quadrant, which is where we are today, is this massive outlier. And this is a year where stocks are down over 10% and bonds are down over 10%. That essentially has not happened in over 45 years. So this is a big, like it says, a massive outlier. Investors aren't used to this. The reality is that it has been a painful start to the year. And, we think it's going to be tough waters, a lot more volatility over the next 6 to 12 months. So we want to help investors understand that, the volatility is probably here to stay. But just know, like, normal diversification in this environment's been tough because of this reality. So just wanted to make mention of that. And, in July, we'll go into a little bit more deeper into the weeds on what we think and, what we're doing in terms of taking any action regarding managing your assets. So, all right. So let's just kind of look back and say, how did we get here? So there is this old adage when it comes to investing is don't fight the Fed. And the Fed is the Federal Reserve, right? So when you think about the whole idea of fighting the Federal Reserve, or what that means is that the Federal Reserve sets policy. They set policies around, are we going to be neutral, which means we think the economy is doing fine. We don't think it's, too hot. We don't think it's too slow. We think it's just doing fine. So the Fed takes the approach of we're going to be neutral. Then we have the other scenarios where the Fed wants to be stimulative. They want to help the economy. So how do they help the economy? They cut interest rates, right? They make the cost of borrowing cheaper, or they also print money. They put money into the financial system to help keep the economy moving forward. So that's really in a stimulative perspective. And then the Fed on the other side can take the approach of we need to slow the economy down. The fact that the economy is growing too fast, we actually need to slow things down. And so what do? They raise rates, and then they instead of printing money, they do the opposite. They start pulling their money out of the market. So they're actually taking money out. So the reality is, over essentially the last 10 years, the Federal Reserve has been propping this economy up, propping the markets up, which is meant for stock investments, for real estate investments. They've done really well because the Fed basically gave cheap access to money and a lot of money. And what started essentially the beginning of this year, or in the fourth quarter of last year, started raising rates and started to pull back some of the money that the Fed put in the system. So the whole idea of don't fight the Fed, the message there is you got to look at it from both sides. When the Fed is trying to stimulate, you got to ride the wave. And when they're trying to contract or slow things down, you got to also be more cautious. And so that's a little bit of our message today is it's not abandon your investment strategies. You still want to maintain diversification. Diversification asset allocation still works over long cycles, even through recessionary periods. But the whole message is that you have to realize that the Fed is trying to kind of pull back on inflation, trying to slow things down, and that's going to have an impact on asset prices. And you're already seeing that now, and that's going to continue, we believe, for the next 6, 12, 18 months. And every asset's a little bit different. So we're going to spend some time on that. So how do we get here? So this is a really easy chart to look at. So the Federal Reserve controls the Fed funds rate. And when basically rates went to zero, so this happened post-financial crisis. So you can see on the very far left-hand side, this chart is on the left-hand side, it says the percentage of rates. And then down at the bottom, it shows the years. So the chart goes from January of 2008 all the way up till today. And you can see the chart's almost, you can't even really see it because the data is down at the bottom, zero. So the Federal Reserve basically slashed rates after the financial crisis. They cut them to essentially zero. It stayed at that level for 6, 7 years as the economy repaired itself. Rates started to rise back up because the economy was in a good place, but then COVID hit and you can see they slashed down, and you can see the dark, there's some dark gray on the screen that represents recessionary periods of time. So you can see rates cut down to zero. We've had zero rates for the last basically 2 years. And then starting this year, rates started to go up as the Federal Reserve took an approach to start to raise interest rates to slow down inflation and to temper some of the asset price increases. And so basically what happened in a very simple way of thinking about it is when rates went to zero, money went into risk assets, right? Because if you have cash and you were making 3, 4, 5% on a CD bank account, and now it goes to zero, guess what? It incentivizes you to start taking more risk. It says, well, I don't want to make zero because after inflation, I'm actually negative. So I want to take some risk. And that's exactly what happened. So a lot more money flowed into risk assets. And so the value of these assets went up, but not necessarily a lot more economic activity. And really, when the Federal Reserve cuts rates to zero and also prints money, it's a little bit of this fake money, and it kind of distorts the economic cycle. And the Federal Reserve tries to do that because they want, we all want a robust economy, right? Because when you have a robust economy, that means people are working, people are spending, people aren't worried about their jobs, they're not worried about paying their bills at an economic level. So we want economic growth. The challenge becomes when they had this policy in place of zero interest rates for so long, it really distorted things. And now we're going to have to pay the piper, so to speak, and actually reckon with some of these issues that have been created by the Federal Reserve. And we're going to talk a little bit about how that, how that unfolds. So I'm going to just give you some evidence of this data. So this was just we talk about speculation, or we talk about money going to risk assets. We're going to talk a little bit about this like speculative fervor, where people are just like, hey, I got to keep, I can't lose money in the housing market. I can't lose money in stocks. I can't lose money in crypto, right? That was kind of a theme of everything was working. And so this chart was just from the journal just the last few days. It showed that using this Case-Shiller National Home Price Index, that in March, that home prices appreciated 20% year over year. Well, I think we all know that real estate over time tends to appreciate by 3 to 5% per year. That's a natural rate of appreciation. And so that's normal, that's healthy. When you get periods where home prices are inflating by north of 20, that's unhealthy. Number one, it's not sustainable. And number two, it's just not good for the markets. And so that's what we're seeing. Now, the Federal Reserve had this, they knew this was happening. And as I kind of believe, shame on them, they should have been more proactive last year. I think the decisions they're making today, being in June of 2022, this needed to happen in June of 2021 because things were already rebounding and you could see the writing on the wall. They did not make these changes. And so from an investment perspective, you had to continue to invest, but the Federal Reserve should have been a lot more adamant about this because of these home price appreciations. And so we do think this is going to roll over and slow down. We think that's a good thing. I do get the question a lot. Do you think the housing market's going to implode? I don't think it is. I think we have supply issues. We still have a limited supply in most markets. So I think it's going to level off with some minor declines. That's at least kind of my outlook today. I'm going to give you more info on that in July as we do a little bit of a deeper dive, and I'll have more of a robust section on the real estate market. The other thing is, so when we talk, we're kind of going through the speculative conversation. So real estate, obviously 20% gains in the real estate market, not normal, not healthy. There's also speculations in what we call these COVID stocks, right? So all the work from home stocks. And as I was preparing for this, I kind of realized how much similarities that we had in this. If you remember the Y2K as we were transitioning from 1999 to 2000, and the similarities of the Y2K phenomenon and the dot-com boom and the dot-com bust. And if you remember Y2K, there was this whole theory that, okay, all of our computers are going to stop working because of the way that the coding was when everything switches over from 99 to 00. And then, so the technology spend was pretty massive in 98, 99, getting ready for this Y2K event. And it was benign. There was no real issues. The economy adjusted. However, by the Y2K effect pulled forward all this demand into the late 90s, which caused all this additional spending to get our economy ready for this phenomenon. So what happened is all this demand got pulled forward, and then in 2000, 2001, and 2002, so much of the money that needed to be spent in those years got pulled forward into the late 90s. And we think that's really kind of what happened now, looking back in hindsight with COVID, is a lot of this work from home play, the switch to Zoom, the switch to not commuting, having more of a flexible work schedule, all the demands that are going to be needed for that. People wanting bigger homes, maybe a home with a yard. They need multiple homes now, or multiple, a much bigger house because they need to have a gym in their house and have an office in their house, right? So there were all these things that happened at the consumption level, but also at the work level because of this work from home phenomenon. And so stuff that probably would have taken us all as a society 2, 3, 4, 5 years to implement, because we kind of know that's the norm. And we have a lot of clients who are retired who love meeting us in person, and we love that too. But now, because of COVID, they're kind of like, you know what? I don't need to drive 30 minutes or 45 minutes to come into a meeting. I'm totally fine doing Zoom. And that's the change of the mindset that many of us have, is we're willing to kind of adapt technology to make changes. Well, because that was forced upon us because of COVID, all of the demand that, this normally would have taken, let's say 3, 4, 5 years to happen, it all got fast forwarded into 1 year. Like it had to happen instantaneously. And so think about the demand that was put in place. And so that's what we call kind of these COVID related stocks. And so there was a lot of speculation around funding these next great companies. And so if you look on here, and these aren't recommendations, I just pulled this as a sampling. So don't take this as recommendations. This is basically just data that I wanted to share with you, because the reality is we've already started to see major pullbacks in the stock market. And while the broad markets are down in the 15% range, when you look at some individual companies, it's much more painful than that. For example, Netflix is down 71% from its high. Facebook is down 49% from its high. Amazon is down 34% from its high. Google is down 23% from its high. Shopify, an online retailer, is down 78%. PayPal, which owns Venmo, is down 72%. Zoom Video, right? We're doing this on Zoom. Zoom Video Communications is down 73%, and Roku is down 80%. So you've already seen a lot of pain come in. Not to say there might not be more, but some of this correction has already occurred, just given the reality of what's happening in the financial markets. And so, one of the things to remember, and I don't have this ready for today's conversation, but if you look back at the history of our major downturns in our economy in the past, we had the Great Depression, we had the periods like the most of the 1970s, we had like the dot-com era, we had the financial crisis. Many great companies are formed during times of economic recessions or depressions. And so many of our great US companies were formed in really difficult times. And so that's one of the things when we start looking at is like, don't be afraid. We do really believe is wealth is built during times of recession because opportunities are abound. And that's when great companies get started. So while this pain has occurred, we think a lot of it is priced in. And think about real estate hasn't really adjusted. So when you're thinking about investing new capital, it's like, okay, a big basket of stocks have already corrected 50%, maybe 60, 70. And then I'm looking at the real estate market hasn't really started. We're starting to see that, but it hasn't really started in any big way. So you have to think about, as an investor, where do I want to put new money? Because we definitely are starting to see some opportunities out there. I know I did a crypto and digital asset webinar a few months ago. If you didn't get a chance to watch it, it is on YouTube. Please take a look. It'll just give you a little bit of insight as to the digital asset market and what our thoughts are. And I have a couple things on here. So basically, it's estimated by the journal that over the last 6 months, about $1.5 trillion in value has evaporated from the crypto markets. And you can see the chart over here as things peaked, the crypto market got north of 2 trillion, almost like 2.25, and now is below $1 trillion, right? So you can see that, and that's real money, right? If that's your money now, and you multiply it, you kind of compound that over the entire, all the investors around the world, that's a lot of real money. And when that money gets lost, it can't be spent. It can't be put in other assets. It's lost because of the volatility to the downside that we've seen in crypto. And the speculative fervor that we've seen again in all of these assets, this is not just crypto, it's stocks and real estate. It's just because of this cheap money, this flood of cheap money that is now stopping. So that's why this is so relevant. And one of the things that I know we can always look back at, like, okay, well, how can we tell that some of this speculation is happening? And I have a couple examples here. The Staples Center right here in Los Angeles is now named Crypto.com. If any of you watched the commercial, Super Bowl commercials, there was tons of crypto related commercials, and most of them didn't even make any sense. And so that tends to show you that money is being spent maybe in an irresponsible way when you get to these inflection points where there's a lot of demand, a lot of excitement, but maybe at the point where, hey, this might turn over, and we're already seeing that happening. And the reality is as an investor, as your financial firm, and we can't predict the future. So what the key is when you're making decisions, you have to adjust as things go, and you have to have discipline around the decision making, knowing that you can't predict what's going to happen. Now, in hindsight, it's always fun to go back because we can now use this data as a way to reflect and learn and get better. But none of us have a crystal ball. Nobody does. But it's just, again, I wanted to talk a little bit about like how we got here, and then we're going to address like, okay, what now? So the big topic of the day is inflation, right? That's what the Fed is freaked out about. And at the end of the day, inflation is basically rising of prices, and essentially happens when you have too much money chasing too few goods. And at the very core of our inflationary problems, there's a lot, but there's just too much printed money. Our government printed money. We sent checks to people we sent checks to people, to businesses, to really shore up our economy due to COVID. Now, the reality is that should have been pulled back. And again, we can be like a Monday morning quarterback, so to speak, and we can evaluate in hindsight. But that should have slowed down about a year ago, and it continued. And so too much money got into the system. It's causing inflation. There's lack of supply issues that we're seeing. There's too much demand. So the whole thing is, we do think inflation is going to come down. The inflation du jour right now, the inflation concern of the day is basically that inflation is going to keep going up. It's going to keep being a problem. And I don't see that. I think inflation is going to start turning over and starting to come back down to some normalcy. And it's like, well, what's going to bring it down? The Fed action on interest rates, the supply chain on a global scale being fixed, energy prices coming down, and stop printing money. That's a big component. The other thing too, when we start thinking about, we do think it's going to slow dramatically. And here's one of the big reasons is there's something called the velocity of money. And so velocity of money is measured by how fast is money turned over. So if you earn $1,000, how quickly are you spending that? Like, how quickly does that money make its way through the economy? When the economy is doing really well and it's really robust, velocity of money tends to increase because we feel comfortable that if I make this money, I can spend it. And then by you spending money, it drives economic activity, because then someone else can make a living and then they spend that. And so you have this higher velocity of money. When you go into some of these recessionary environments, or when people see their stock portfolio decline, or their crypto portfolio decline, or their real estate portfolio decline, they start getting a little bit more cautious about spending, and that slows down the velocity. And when you slow down the velocity, that brings inflationary pressures down. So that's what we're seeing that's going to start happening. And the consumer is going to have a little bit of lag. What I would call the smart money is kind of anticipating that, and the consumers are probably at different pockets around the US starting to feel it. It's definitely not on a national scale yet, but we do believe that that's what's going to be unfolding over the next 6 to 18 months, is that consumers are going to start feeling the pinch at different times, again, depending on what industry they're in, if they're working, if they took a pay cut, things like that. So there's a bunch of data on here, but basically, We do think kind of this summer, we're going to see some peak inflation. So we start seeing commodity prices kind of roll over. We are getting to a point where people are starting to make decisions of like, you know what, maybe I'm not going to travel this summer. Maybe I'm going to stay at home because gas prices are too high, or, I'm going to make decisions. I'm not maybe going out to restaurants because food costs have gone up dramatically. And so people are starting to make some decisions. We are starting to see inflation start to slow. So that is kind of our outlook, is that inflationary pressures are going to come back. Part of it because they, when you're comparing to last year, we saw really high inflation. It's a natural thing that inflationary numbers will come down. But also because if we get a slowdown, there's gonna be less demand, which will start pulling prices back down. So we're just looking here as this is a commodity index on the left-hand side, and then the CPI index, kind of the projection of where we're gonna head. So we do think it's gonna come down. So we think inflation is less of the risk, more as, okay, how do we navigate through a potential recession is going to be more of the risk for us as investors. So I talked a little bit about, don't fight the Fed. So just want to address what's happening now. So if you actually look at the markets over the last 10 years, there's a high correlation between the stock market and the Fed printing money, which means when the Fed was actively printing money, and they report this data because it's referenced on their balance sheet, when they actively are printing money, you can see the stock market was going up. And so they're highly correlated. So what we know they're going to be trying to do is they're currently trying to remove about $3 trillion from the US economy. They're embarking on trying to do about 90 billion per month. So we do know that this is going to be definitely a headwind for investors as this money starts to come out of the markets. Remember, when cash comes out of the markets, that means there's less cash to do what? To buy stuff, and whatever that stuff is. It can be oil, it could be stock market, it could be real estate, whatever that is. And so as that cash comes out, that means there's less demand because those dollars aren't there, which will put some pressure. We think a lot of that has been priced into the stock market thus far, but it means in the near term, we still might see some downside weakness, and we're expecting that. Over this past 7 months, so basically since the markets peaked back in November, about 14% of wealth around the world has been destroyed. So just through stock market declining, real estate, through primarily stock, not real estate yet. So primarily stock and crypto, about 14% of the wealth. Just to give some perspective, during the Great Recession from 2007 to 2009, about 19% of the wealth was destroyed over that period of time. And so, given that when wealth is destroyed on paper, people tend to spend less money, they feel less confidence. The question becomes, is a recession inevitable? Because of just that fact alone, the fact that all of this money out there has been basically destroyed because values have come down, right? People are noticing that in their brokerage statements, their 401ks. So that's kind of the reality that we're looking at. Is a recession inevitable just because of that fact alone? And we're still seeing most experts, kind of look at this saying, okay, the odds are going up, odds are ticking up, but they're still remote. We don't share that. So if you look at these two charts, I just want to walk through, and there are some nuances here, which is, we don't want to be alarmist. We just think this is the reality of looking at what's happening, and economic cycles are normal. It's no reason to say, okay, I'm not going to be an investor. We still want to maintain that discipline long-term. But if you look at the chart on the left, basically this shows one of the biggest challenges that our economy has right now. And this really hasn't been a phenomenon to this magnitude that we've ever seen, or at least seen in my lifetime, where this shows on the left-hand side the initial jobless claims, which basically is the amount of claims that are being made, basically unemployment claims. And then you're looking at on the right-hand column, basically showing the total job openings. And so, what's pretty remarkable when you look at this data is, initial jobless claims, unemployment rates at 3.6%, crazy low number. But then look at the job openings. There's a massive disconnect here of how many, there's, I think it's something like 5 million person differential on job openings and unemployed. So that's a huge issue for our economy. And most business owners that we've been talking to, their number one issue has been around finding good people and finding people who want to work, and finding people who want to work at what's called a reasonable wage. And I know that's a little bit of a vague way to describe that, but that's one of the biggest challenges that business owners are having, is finding good people that want to do the work. And that's pretty much across all industries. And so I do believe that a recession fixes that issue, because what it'll do is job openings are going to shrink a little bit. I do think we're going to have layoffs, and we're already starting to see that. but also people who are just getting checks to stay at home, or they were making money trading their stock market accounts, or they're trading their crypto or their NFTs or whatever they were doing. If they're losing money there, they're going to have to start getting back to work and not just rely on either a check or on the investments. And so we do think this is going to change the labor market, starting to start to see some signs, but it hasn't really hit yet. We think this is going to be something that's going to be coming pretty quickly. On the right-hand side, we're looking at a chart that says U.S. household wealth. And you can see the dotted line that's running through there is kind of a historical trend, right? So that historical trend is basically just assuming that, you know, our net worth as a nation tends to go up by 3 to 5%. So that dotted line is kind of representing that over time it should go higher. And if you notice basically what happened since COVID started, kind of on the far right-hand side of that around 2020, the household wealth, you know, basically spiked well above the historical trend. And so the reason why asset prices have continued to go up, like in real estate, is because, you know, prices keep going higher. People still want to demand, they want to buy a home, they feel like they're missing it, and people feel flush with cash. And so it's caused this to get higher and higher and higher. The reality is that can't continue. It's not going to continue. And that historical trend will probably stay in place. So what's going to happen is this household net worth is going to start rolling over and come back down to this normal trend line. So why is that significant? Again, coming back to this whole idea is when consumers feel wealthy, they spend more money, the economy is more effective and it grows faster. When consumers don't feel as wealthy, they start pulling back spending, which slows the economy. So these issues are all interrelated. One of the dynamics that we do have with the consumer, because this is the big question that I do get, is, was the consumer next? And so again, this was just from the Journal a few days ago. So that's why I still think there's a little bit of a disconnect between reality, what's happening kind of underneath the surface, and what most people are seeing. Household boost spending. So you can see personal consumption expenditure price index changed from a year earlier. So people boosted their spending by 6% from a year earlier, right? So that shows you a really healthy economy, right? Well, the reality is a bunch of people got to refinance, and I know there's many on this call, if you still have mortgage debt, a bunch of people got to refinance their homes at crazy low rates, 2.5%, 2.75, 3%, right? So the fact of people being able to refinance and save $200, $300, $400, $500. I had one client do it and they saved $1,500. They had a large mortgage, $1,500 per month just by being able to refinance at one of these low levels. Well, when you refinance your mortgage and now you have a lower payment, that's money that can go into the economy. Well, the reality is that refinance cycle is done. Mortgage rates have really spiked. And so that's not going to help boost the economy anymore, but it did in April. And that's why you can see these forecasts. This is done by, I think it's by the Federal Reserve Bank. They're kind of forecasting this to come down. And we totally think that is going to happen. That's the reality, is this boost of consumer spending is not going to continue. This also shows that this represents this chart, personal savings as a percentage of disposable personal income. You can see historically, we've kind of been in this 4 to 5% range. So on this chart, we're looking at 2008 up till now. Back in September of 2008, you had personal savings rates about 4.3. Today, we're at about 4.4. But look at the phenomenon that happened in 2020, 2021, and 2022. So savings rates spiked, right? And it makes sense because the government was sending you money, whether it's through unemployment, disability, COVID relief, child care credits, all kinds of things, PPP, EIDL, money was coming into the system. And for the time there, especially early on in COVID and in 2020, people weren't able to spend the money, right? So you just built that up. You just saved it because you said, well, can't go anywhere. Everything's shut down, so I'm going to save it. Well, that now you can see savings rates have really plummeted and people are spending that money. So we don't feel like the consumer is tapped out. We still feel like there are reserves, but those reserves, unless we really get consumers to get back to work in a bigger way, those reserves are going to start to actually get spent. And we're starting to see some signs of the consumer cracking a little bit because we're seeing credit card balances increase. And so usually credit card balances increase when their savings have been depleted and they're still spending money. And we know like prices have gone up, right? Gas prices are significantly higher. So people are starting to build some higher credit. So it's not in a problematic level yet, but we're starting to see the trend that it's going in the wrong direction. So we do think the consumer is relatively healthy, which is kind of the exciting part about this is, yeah, I do think we're going to head into a recession, but I think we have some really good ways to get out of this in an effective way. So let's talk a little about this, staying on this theme is the consumer next? So again, positive news, the refinance boom lowered monthly payments. And then what's on the horizon for the next 6 months, 6 to 24 months? Because of inflation, net wages are down over the past year, right? Net wages. So how that basically works is if you got a 5% increase in your wages, but inflation of the things you consume went up by 6%, 7%, your net wages went down relative to inflation. The next note on here is danger, free money. We were giving our and basically Americans too much free money not to work. And so consumers got used to living a lifestyle, and that's going to need to change, because at the end of the day, the way that an economy functions well is you get paid a wage to produce a good, a service. It's not designed to have you get paid a wage to not produce. Like, that's the only way our economy long-term can be effective, is you have to produce something as a human being, right? That's how you live well. And so the more you can produce, generally the more income you can make, or so that's one of the dangers we've had right now, is we've had some free money for the last 2 years, and the lifestyle that a lot of consumers have gotten used to is going to need to change and need to shift. Great news though, we have 2 easy solutions for this. So get back to work, get a second job. I mean, that is the reality. When we go into hard times, you have to be making sure, all right, go back to work, make sure you are working and earning more income if in fact you're struggling from a cash flow perspective. I do have some actionable items that we'll get into at the very end, but the other thing that I want to get into, this last item on here, is labor force participation. So the reality is there's a lot of people in our society that aren't working, that can work. And so the good news is, you go into a recession when labor force participation rates are low, that means there's actually a lot more workers that can get back into the markets. And our companies are demanding that. That gap that we're seeing, where there's a lot of jobs that are open, but there's not a lot of people looking for those jobs, tells you that we do have to get this labor force participation rate. And that's why, kind of at a thematic level, when I talked about we are in a recession and why it's a good thing, because it's going to reset the labor market. Like, the fact that, companies are struggling to find workers is not a healthy thing for the economy. Like, that should be a lot more efficient. And so I wanted to pull up a little bit of data on here. I don't want to make you an expert on this, but just so that you're aware of this term called labor force participation rate. So this data goes back to, I think I ran this back to 1970 all the way till today. So it shows on the left-hand side the percentages. So, if we look at periods of time like 1980, 85, 1990, it shows that labor participation rates have kind of been in the 64 to 66% range. Around 2000, it got as high as 67%. So if you look at the definition below, basically it's defined as the number of people in the labor force as a percentage of the population, and the participation rate is the percentage of the population that is either working or actively working, looking for work, right? So what we've seen since 2000 is this rate has come way down. And look at the very far right-hand side, you can see the participation rate, got down to 60%. And a lot of that was COVID. And so you're seeing, or it's not a lot of it, all of it was COVID. And you're starting to see that improve. But we do need this labor force participation rate to get back up to like 65, 66%. Because if we just get that back to some normalcy, that change alone will put enough workers in the economy to fulfill those open jobs. So that's a big part of what's going to help us get through this, is just getting back to work, because that's the only way to really solve things, right? And if you want to get a paycheck, you gotta produce, and that's what's going to be required. So let's talk a little bit about, if we are right and we're kind of heading into this, like, what happens? And we're talking about there's obviously, in my opinion, good and bad that happens. So bankruptcies, we're going to have more bankruptcies, personal and business. Layoffs are going to start. There's an interesting website if you're curious, if you're into more technology. There's a site called layoffs.fyi. You can actually see a lot of the startup companies and how they're laying off. And you'd be surprised, there's a lot of big companies that you would know that are actually laying off behind the scenes, and you're not hearing that yet. Borrowing money becomes more difficult. So the reality is, because of bankruptcies, because of layoffs, because of borrowing money becomes more difficult. What's important? Well, you as an individual, you have to spend money to live your life. If you're a business owner, that's a whole other complex conversation. But just as an individual, you need money to spend, to live your life. on the necessities, on the wants, the travel, all the things you want to do. And the reality is when we go into periods of time where there's layoffs, if you lose your job, that's going to impact your ability to spend. If you were potentially borrowing money to help get through a tough time, whether through credit cards or different sources, borrowing money is going to become more difficult, and it's going to be harder to get access to money during a recessionary environment. And so you'll see on some of the action items is, build some cash reserves, be ready for this. And so especially if you fear that you might be in an area where you're going to be potentially laid off because of a slowdown at your company or in your industry. The crazy part, though, is like the positive shining, I guess the benefit that I look at this is historically, now this is, we don't know what the future is going to hold, but historically is the best time to build wealth. When you go through a period of assets coming down in value and you continue to invest through that period of time, it's a really good time to build wealth. And so that's the one thing to remind everyone as you go through this pain. It's a temporary pain. So that's why you have to be prepared for that. But it's the best time to be an investor and to make decisions through the downturn because you're able to buy good assets at more reasonable prices. So again, kind of coming back on this, why recessions are a good thing. Speculation slows. Like massive speculations is not healthy for the economy. It's just not good. So speculation slows as assets reprice. And sometimes it actually goes worse than it should. So that's one of the things that I've always kind of try to use an analogy that says, if you think about a pendulum, right? So the pendulum goes back and forth, back and forth. Generally, from an economic perspective or from an investment perspective, the pendulum swings farther than it should, which means things generally, when they're going good, they get too high. And then on the flip side is when they get bad, they go down more than you think. And so the pendulum always swings wider than it should. And a lot of that is because of human nature, because of the fact that we are wired to be fearful and greedy, right? So when things are swinging to the upside, we're getting more greedy. So we want to experience that the higher gains. And on the flip side, when things are going down, we're wired to be more fearful, which causes sometimes more selling because we're panicking or making bad decisions. But they're a good thing because it slows the speculation and speculative nature of the markets. Too much of it is really what can wreck the economy. We want to have growth, but we want to have controlled growth. Bad companies go out of business. There's just some bad companies, poorly managed companies, they're going out of business. It also resets the business cycle. It kind of flushes the markets and flushes the economy, starts a new business cycle. No more overpriced talent. You've heard a lot about people jumping from job to job to job to job, getting more money, and it became a little bit of a game. I do think what's going to happen is you're going to have a lot more employees be more loyal to good companies and say, hey, this is not just about maximizing my pay. It's going to be, I want to be in a good environment and get paid a fair wage and be bought into more of a culture and a philosophy of what companies are doing. So I think a lot of the overpriced talent, I do think is going to start getting cut. We have not seen that yet, but that's one of the things that I think could cause this recession to be a little bit more, is if some of the big companies like the Apples and the Googles and the Amazons start really cutting some of their mid-tier executives or high-level executives, realizing that these people are really expensive. Do we still need them? And I think you're going to start seeing that. So I think some of this overpriced talent is going to get worked out of the system. And so if you are in that category and you're like, wow, I get paid a lot, you better be improving your value to those companies, because I think that's what's going to happen is there's going to be some cost cutting because companies don't want to just burn through cash. They want to be smart about it. And then access to new talent. When you go through a recession, there's a lot of new talent available for companies that have a growth mindset and want to grow. The good news now is they can go find good talent that are maybe coming out of some of these firms that are downsizing. So that's the exciting part, is that I do think there's going to be this influx of available talent for companies to be able to attract, especially if they have a good compensation structure as well as a really solid culture. Some of these headlines that we're seeing, you're seeing it every day. I mean, I think I saw today Tesla, Elon Musk is like, get back to work. Netflix has kind of taken this approach with, to workers, if you don't like our content, quit. I know Apple is talking about bringing people back to work, and one of their divisions, I can't remember, said, no, I think we want to still work remotely. And they basically said no. And so they kind of said, okay, we accept your resignation. So this is happening more. A lot more companies are mandating getting people back to work, because I think they're starting to realize that being flexible is good. But there's a big benefit of these companies of having their workers present, working together as a team. And so I think you're going to start seeing a lot more pushback here, where flexibility is okay, but it's not going to be flexibility at all costs. I think companies are going to regain control of the culture they want to set. And then you can see on the left-hand side, the return to work rebellion gets serious, right? So up until I think now, like literally today or this last month, companies could, or a lot of workers could still push back and say, nope, I'm not coming back. I'm not coming back. I think up until now, companies now are saying, okay, if you're not coming back, you don't have a job. And I think that is stopping, which I think is a good thing. That's just my personal opinion. You might disagree. So the gig economy, you guys have heard about the gig economy, right? It's working gig to gig. It's somebody who's kind of really wants to have flexible work, who can drive a Lyft car, drive an Uber, do DoorDash, have an independent business that they can run. So the reality is, going into a recession, gig workers will thrive, right? Because if you are working and you're not getting paid enough, or you or your hours get cut back, or whatever might happen, the great news is now more than ever, you have the ability to go make a living doing something else or something on top of that. And that's, it might be the reality of, okay, I got to work more. But the reality is, when you go into recessions, you kind of do anything to survive and to make sure, your family can be taken care of. You make sure your cash flow is not overly disrupted. And so you look at these models around Lyft and Uber. I mean, we all know, if you take a Lyft or an Uber around any town that you live in, and you can speak specifically for Santa Clarita, there's not enough drivers. What used to take 5 minutes to get a car takes 15. Costs have gone up triple. I don't mind the cost part, because you got to pay the driver fairly, you got to pay for gas. But we're still in a period of not enough drivers. Cars aren't being fully utilized. So that's a big part of this economy that I think will be okay, right? If you lose your job, you can actually get a job right away with Uber and Lyft if you have a car, right? And they'll even help you in that area. And then Fiverr, again, I'm not recommending any of these companies as an investment. I'm just going to shed some light on why, going into recession is going to hurt the consumer. But first time in any generation, we actually have the ability as a worker to control our destiny. If we lose our job, we have so many options to go back and do flexible work that was never there before. Fiverr basically is a online tool that basically allows freelance work in a variety of workplaces, from home to office, all these different things. So basically, if you're a graphic arts person, or you're a photographer, or whatever we can think of, you can basically list your services there, and people, if they need jobs, they can come find you and you can bid for jobs. And so this is what I get excited about is, I do see the recessionary pressures coming. I do think it's going to be disruptive to a lot of people, but the beauty is we get to adapt. Our economy now is at a point where we can adapt, but to adapt, you got to work hard. There's no shortcut for that. You have to put the work in. And we all know that, right? And it's like anything. I know you guys all know, I have teenagers, and you start getting into that, okay, working hard in school, getting a job, working hard, it's all about, and that's kind of why I think it's a good thing, because we've been living through a period of basically free money, and it's time to reset that and get people back to producing. And that might sound really harsh, and I know everyone's situation is a little bit differently, but that's kind of what I'm excited about. And the great news is, like I have up on the screen, there's great tools that people can basically sell their services and based on the skill sets that they have, and should not have any disruption in cash flow, because there's so much available to people. So one of the things that I want to caution as we're kind of wrapping up is this whole idea on, people like to invest their money and make decisions based on economic headlines. When they see an economic headline about inflation or about the stock market going down, too often the emotional part of us wants to make decisions based on that. And I will caution you against that, is do not invest based on economic headlines. If you do, you will be wrong more times than not. Because the reality is, if we look at today's economic headlines, there's a lot of bad news. Well, the stock market, and now that we see this in hindsight, peaked in November of last year. And we've seen it come down since then. We likely will officially be in a recession in July. And what has always been known, and this doesn't work perfectly, but has always been known, is usually the markets peak about 9 months prior to a economic decline. And so theoretically, we've had some slowdown. We'll officially, we don't know this data yet, but I think we'll be in an official recession in July, which means that the markets essentially peaked 8 to 9 months prior. And so and a lot of times then, once the recession is announced, then the markets have already adjusted. So you don't want to make investment decisions today because things have already corrected. And I showed you that long list of a bunch of companies. And so I'm not saying the markets are screaming buy here in July. I do think, or June and July, I do think we're going to see a lot of volatility over the next 6 to 12 months as we work through this. I think there's going to be great opportunities. I think it's going to be really important to be disciplined about your investment decision-making. One of the things you've already noticed from us, we've been doing more rebalancing and adjustment because the volatility has been so big. So we're trying to make those good decisions dealing with the volatility. So that's number one in the stock market, is be really careful of making decisions based on economic headlines, because that is where investors get in trouble. The other part is real estate market. The real estate market is a different animal. The real estate market tends to have a lag effect. So coming out of the financial crisis, the bottom of the stock market was March of 2009. The bottom of the real estate market was March of 2012. So it was 3 years later. So be mindful of real estate. I do think real estate's going to hold its own longer than we think. So we're going to have a little bit of a disconnect where the stock market's going to look kind of ugly. Real estate's going to start, you're going to start seeing some price adjustments. We're already seeing that in local real estate, but not like a major sell-off. Just simple fact is there's not enough supply. And so, but we do think that kind of most of the demand for real estate got front loaded, and that prices are really going to level off here for the next 3 to 5 years. With the exception of what I would call poorly priced properties, the properties that nobody wanted to buy, but they felt like they had to because there was no other inventory that sold at a ridiculous price. Those homes, in my estimation, are not going to hold their value. But it's a supply demand issue. So just remember, be careful with making those decisions, because again, the economic headlines drive the fear and the greed in us, and it doesn't allow us to make better decisions as investors. So as we wrap up, some of the key takeaways, I kind of broke this down into 5 areas. And I do think it's really important. I don't think we're on the precipice. Don't come out of this saying, oh, John said we're in a recession and this is all terrible. I don't feel that way. I do feel like we need to be a little bit more cautious. And so the takeaway from this should be more cautious, be more careful. So number 1, evaluate expenses, cut back on unnecessary stuff, go through your credit cards. And if you're getting dinged on these $10 charges, $20, $30, things that you're spending money on, that's a total waste. Like, be more disciplined about your expenses, be more careful there, be more purposeful. That's number 1. Number 2, build cash reserves. Especially if you're in an industry where you might see some downsizing, if you're a little bit more careful, build some cash reserves. So when you cut back on some of the expenses, build reserves, because what that really does is it gives you more peace of mind of knowing, hey, we're okay, we have some cushion. And that's usually recommended 3 to 6 months, depending on the industry. Number 3, continue to save and invest. The big takeaway out of this should be continue to invest. Continue to invest in your 401k. If you have the ability to save money and you already have your cash cushion built, continue to invest in financial assets that can grow over time. This should not be a time where you stop investing. What I would caution you on the investing is avoid making big purchases, big, large lump sum investments. I would caution you to say, make smaller decisions known as like dollar cost average, invest on a regular basis. But you should continue to invest through this, because those that invest through tumultuous markets are those that do really well on the back end. Number 4, evaluate your portfolio. Now, we're doing this for you if you're a client of ours, but make sure you have the proper asset allocation. Make sure you aren't taking on too much risk. People will probably be surprised on how much risk they're taking. When's the last time you did a deep dive on the portfolio, reevaluate it? And if you want our help in this, then you can schedule a meeting. And then tax loss harvesting. While I hate seeing accounts go down, there are opportunities in taxable accounts to harvest losses that then actually help with tax mitigation in the future, which I love. I mean, that's one of the things that we can control, is that we can make decisions today that save you taxes tomorrow and the next year. I mean, that's what we can do when we manage portfolios properly. And then number 5, focus on your health. When you start going into an environment where you start seeing headlines about recession, layoffs, home prices declining, when you start seeing all this starts to weigh on you. And we all know that. And it's like that check, we all got to check back in and make sure we're focusing on mental health, physical health, and like the fuel, right? The food that we're eating. And so be more purposeful around that. I know a lot of people going into COVID paid particular attention to getting healthier. And that was a small group, maybe 10%, the other 90% drank more, ate more, they weren't as healthy. They didn't take care of themselves. And so I think this next transition is a reminder of like, take care of yourself, because a lot of this stuff that I'm talking about today is totally out of our control. Where the economy goes, what the Fed does, what our government does, we don't have control of that. We do have control on taking care of ourselves. So make sure you're setting yourself up to be the best version of yourself. So those are just some suggestions. hopefully this has been helpful. Again, we kind of did this webinar here as like a, in between our monthly ones, because I did feel like this was a message I do want to share. But this is not a time to sit on your hands. It's a time to be proactive and be just cognizant of this issue. I unfortunately have also been seeing too many scare tactics where people are like freaking people out, the next stock market crash and all of this. We're going to have some volatility. There's no doubt about it. And it's going to continue. Trying to predict a crash or an implosion, could it happen? Of course. Am I anticipating that? No. But if you take care of these things on the front end, these key takeaways, then you'll be in a much better position so that if we do go into a recession, if it's worse than I think, or if it's as bad as I think, you will be prepared to thrive coming out of it. And so, again, this is the time where I feel like you have to have more discipline around everything you do. And the thing we don't know is this going to be a 6-month, hey, recession, quick, let's just get out of it? Or is it going to be dragged out for a couple of years? I don't know. My sense is it's going to kind of be more muted, meaning not as bad, but might last longer than we all like. But again, I don't have a crystal ball. So that's just general the feelings that I have, and also from the research that we've been doing here as a firm. So hopefully that's helpful. So most of our clients, we've been doing all of our annual review meetings, as we've been going through tax season, obviously. So you should be on the calendar. If you haven't met with us in a while, feel free to reach out and get on the calendar. If anybody is here joining us as a guest, we're happy to do a 30-minute consultation with one of our advisors here at Vance Wealth. So go ahead and scan the QR code or go onto our website to book an appointment. 2 webinars that we have upcoming. Do you remember, I think it was a year ago, or maybe it might've been 2, I did a If I Were President. And so while that's a really dangerous topic, because you can't help yourself but get into some political conversations, I try to be as neutral and as fair and as rational minded as I can, at least in my own opinion. But I'm going to go through kind of, if I were president, some of the big issues that I think we could fix that are not controversial, where most of us agree on. And I want to go through that and kind of share some of my thoughts and kind of regaining our exceptionalism. I think that's something that, that I get excited about, thinking about what are the things we can do to make a big impact. So I'm going to do that. That's going to be June 21st. And then the July will be our mid-year market and economic update. And that'll be where we talk about where we are mid-year, and then also what our expectations are for things moving forward. So hopefully this was valuable. This was a good use of all your time. I have no questions. We are on the hour. It is noon. So thank you so much for attending. And if there's anything we can do as a firm to help you, to help navigate through, we're here to help. So